The new chairman of the Federal Reserve has just been confirmed by the United States Senate, and he is about to inherit three doors. Behind one door is a crashed economy. Behind the second is a dying currency. Behind the third is the end of American credibility. And there is no fourth door. Before we begin, take a second to subscribe to the channel. If you enjoy deep dives into economics, geopolitics, markets, and the forces shaping our future, hit the subscribe button and turn on notifications so you never miss an episode. Now, to understand why these three doors matter, we need to go back to a library on Madison Avenue in the autumn of 1907. For the past 3 weeks, I've been walking you through a trap that appears to be closing around the United States. If you've been following along, the picture is probably starting to come into focus. And if you haven't, stay with me because we need the full picture before we do the choices that lie ahead. The Strait of Hormuz remains closed. We are now more than 12 weeks into the disruption. Roughly 20% of the world's oil supply has effectively been removed from the market for the entire spring. Oil is trading above $100 per barrel and still climbing. The inflation everyone claimed was defeated last year is accelerating again. The latest core PCE reading was the worst since 2022, and the full impact of 3 months of expensive oil hasn't even worked its way through the economic data yet. The man who is about to inherit this mess and the tools designed to deal with it is about to face a choice that every central bank chairman in history has eventually faced. And when confronted with that choice, every one of them made the same decision. On the morning of October 22nd, 1907, a line of frightened New Yorkers stretched around the block at the corner of Fifth Avenue and 34th Street. They were clutching bank books. They were waiting to withdraw their savings from an institution called the Knickerbocker Trust, the third largest trust company in New York. Collectively, they had deposited what would today be the equivalent of roughly $500 million. By 12:30 that afternoon, the trust had paid out everything it had, about $8 million in cash. Then the doors were locked. The president of the Knickerbocker Trust, Charles Barney, walked home. 3 weeks later, he took his own life. From Knickerbocker, the panic spread. Other trusts faced bank runs. The New York Stock Exchange nearly shut down because banks ran out of cash needed to fund routine margin trades. The Dow Jones had already lost nearly half its value over the previous year. But here's the part that matters, the part that built the world we live in today. In 1907, there was no Federal Reserve. There was no central bank. There was no institution whose job was to step in and stop the financial system from collapsing. So one man stepped forward and did it himself. His name was John Pierpont Morgan, J.P. Morgan. At the time, he was 70 years old, semi-retired, and one of the wealthiest men alive. When the panic erupted, Morgan was attending a church convention in Virginia. He immediately canceled his plans, boarded a special train back to New York, and went to work. For the next 2 weeks, he coordinated the rescue of the American financial system from his personal library on Madison Avenue. He gathered the heads of the largest banks and trust companies in New York. He locked the doors, and he informed them that nobody was leaving until they had pooled enough money to stabilize the system. Morgan personally examined the books of troubled institutions. He decided which were solvent enough to save and which would be allowed to fail. He coordinated roughly $25 million in emergency loans, an extraordinary amount of money for the time. He sorted the wreckage into two piles: the institutions he could save and the institutions he could not. The ones he could not save were left to die, and it worked. And the panic was contained. The financial system survived. But step back and look at what just happened. The largest economy on earth had been saved from collapse by one elderly private banker working out of his personal library. Morgan held no elected office. He had no government mandate. He had no official authority. He had credibility, capital, and the willingness to act. If he had been overseas, seriously ill, or simply unwilling to intervene, The United States might have suffered a collapse unlike anything seen in modern history. The lesson was obvious. The country could not depend on a single wealthy individual to rescue it every time a crisis emerged. 3 years later, in November 1910, a small group of influential men boarded a private rail car in Hoboken, New Jersey. They traveled under assumed first names. They dressed as though they were going on a hunting trip. In reality, they carried draft legislation that Congress had never seen. The group included Senator Nelson Aldrich, senior Treasury officials, and some of the most powerful bankers in America. Their destination was Jekyll Island, Georgia. Their mission was to design a permanent solution to the problem exposed by the Panic of 1907. 3 years later, on December 23, 1913, President Woodrow Wilson signed the Federal Reserve Act into law. The Federal Reserve was born. The Fed was designed to do on demand what Morgan had done manually. When banks needed liquidity, the Fed could provide it. When markets froze, the Fed could thaw them. When panic spread, the Fed could step in as lender of last resort. That is the Federal Reserve's founding purpose, to prevent another 1907. For more than a century, it has largely succeeded. Every major crisis since then, 1987, 1998, 2008, 2020, has been met with the same response. The Federal Reserve creates dollars and buys what nobody else is willing to buy. The patient stabilizes. But there's one question Morgan never had to answer. What is the cost of the medicine? Morgan used existing wealth, cash, gold, deposits, money that already existed. The Federal Reserve works differently. When the Fed intervenes, it creates new dollars, not metaphorically, literally. Dollars that did not exist moments earlier suddenly appear inside the banking system. No gold backs them, no vault supports them, only confidence. Every crisis prevented since 1913 has added another layer to that system. Every recession, every banking panic, every bond market rescue. Each intervention created more dollars, and for more than a century, the pile has grown larger. Today, it rests on an unspoken agreement that everyone will continue accepting those dollars as wealth. That distinction between moving existing money and creating new money is the entire story, because in 2026, that tower is beginning to lean. Over the last several weeks, we've examined what appears to be an increasingly difficult situation. Foreign governments hold roughly $9.4 trillion of U.S. Treasury debt. As oil prices surged and the Hormuz disruption dragged on, some governments were forced to raise cash. To do that, they sold treasuries. When too many investors sell bonds, prices fall. And when bond prices fall, yields rise. Higher yields mean higher borrowing costs. For a country carrying nearly $39 trillion in debt, that becomes a serious problem. The Treasury market is the foundation of the American financial system. If borrowing costs rise too far, interest expenses begin growing faster than government revenues can comfortably absorb. That pressure is now landing on the desk of the next Federal Reserve chairman, Kevin Warsh. Recently confirmed by the Senate, he is about to inherit one of the most consequential jobs in global finance. And when he takes over, he will face three doors. Door number one, save the dollar, raise interest rates, make money scarce, defend the currency. Higher rates attract foreign buyers back into Treasury auctions. Inflation slows, the dollar strengthens. This is the classic central banking response. Paul Volcker did exactly this in 1979 and 1980. Interest rates approached 20%. Inflation collapsed. The dollar strengthened dramatically, but the cost was enormous. 2 recessions, double-digit unemployment, bankruptcies across farming, construction, and industry. The difference is that America in 1980 carried debt equal to roughly 30% of GDP. Today, it exceeds 120%. The system is far more leveraged. Housing is leveraged. Commercial real estate is leveraged. Private equity is leveraged. Corporate America is leveraged. A Volcker-style response today could trigger a financial shock unlike anything seen in decades. Door one saves the dollar, but it risks crushing the economy. Door number two, save the bond market. Create new dollars, Buy the bonds, keep the government funded, keep interest rates contained. This has been the basic playbook in one form or another since 2008, and it works. The government continues functioning. Markets remain liquid, debt remains financeable, but every newly created dollar adds another layer to the tower. The money supply grows, purchasing power shrinks, inflation becomes the hidden tax, asset owners benefit, savers struggle, retirees lose purchasing power. The cost is spread slowly across society. Door 2 saves the bond market by weakening the currency. It is not a fast death, it is a slow one. Door number 3 is different. The United States removes the pressure entirely. The conflict ends, the Strait of Hormuz reopens, oil prices fall, inflation eases naturally, treasury markets stabilize. But there is a price: credibility. If global observers conclude that America entered a conflict and then retreated under pressure, perceptions change. Allies reassess commitments, adversaries reassess resolve, investors reassess risk. And because the dollar's privileged position ultimately depends on confidence in American institutions and power, credibility matters. Door 3 relieves economic pressure, but risks weakening the foundation beneath the dollar itself. So why only 3 doors? Because every alternative ultimately becomes a variation of one of them. Create dollars, destroy dollars, or remove the pressure forcing. There is no fourth door. And here is the single most important lesson in this entire discussion. When central banks are forced to choose between a fast death and a slow death, they choose the slow death every time, without exception. A failed treasury market is a fast death. A weakened currency is a slow death. The fast death arrives in days. The slow death arrives over years. And institutions always choose the path that buys time. JP Morgan made that choice in 1907. He stabilized what needed immediate rescue. The Federal Reserve has followed the same logic ever since. Kevin Warsh may describe it differently. He may use different language. He may spread the consequences across a longer timeline. But if forced to choose between a treasury market crisis and gradual currency erosion, history suggests he will choose the latter. That is what central bankers do. And once you understand that, you stop being surprised. You stop focusing on every headline. You stop obsessing over every short-term market move. Instead, you begin asking a different question. How do you position yourself for a world where purchasing power erodes slowly over time? That is the real question. JP Morgan saved America in 1907 with hard assets, real capital, and existing wealth. He could never have imagined a system where trillions of dollars could be created with keystrokes. He probably would not have trusted it. 119 years later, that is the system we have. And the man sitting at the top of it is about to make the same choice every central banker before him eventually made. The question is not what he will do. The question is whether you saw it coming. If you found this analysis valuable, subscribe to the channel, hit the like button, and share this video with someone who needs to hear it. I'd also love to hear your thoughts. What am I missing? Let me know in the comments below. My name is Jay Martin, and this is The Jay Martin Show. Thank you for watching, and I'll see you in the next one.